institutional investors are increasingly shifting capital away from the US market due to rising concerns over the country's mounting debt, unpredictable trade policies, and the weakening dollar. Prominent figures such as Larry Fink and Howard Marks have expressed skepticism about the long-term sustainability of the US government's borrowing practices, especially after recent tax reforms added $2.4 trillion to the federal deficit. JP Morgan's Jamie Dimon has also warned of potential stress in the bond markets, prompting a re-evaluation of US Treasury holdings. At the same time, erratic trade policies under former President Trump have added to market uncertainty, contributing to underperformance in US equities and making European markets more attractive. As a result, large asset managers like Apollo Global Management, Blackstone, and Canada's CDPQ are reallocating capital to Europe, drawn by political stability and ongoing infrastructure initiatives, particularly in Germany. UK investors committed nearly $400 million to European equity funds in May, marking their largest monthly investment since June 2024. Additionally, World ex-US mutual funds and ETFs have seen record inflows, totaling $2.5 billion between December and April, driven by concerns over US tech sector volatility and broader policy instability. Bank of America surveys also indicate the sharpest decline in global allocations to US stocks, with a growing preference for cash and Eurozone equities. Meanwhile, institutions like Norway's $1.9 trillion sovereign wealth fund are pushing for reforms in EU capital markets to attract more global investment. There's also an emerging consensus that US equities, currently representing around 70% of developed market indices, may be overrepresented, prompting discussions about reducing exposure to as low as 25 to 30%. Altogether, these moves suggest a potential structural rotation in global asset allocation away from the US and toward more stable and diversified markets.